Good afternoon, ladies and gentlemen, and welcome to the RENEWI PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time using the Q&A tab just situated on the right-hand corner of your screen. Please simply type in your questions at any time and press send. The company may not be in a position to answer every question that they receive during today's meeting. However, the company can review all questions submitted today and will publish those responses where it's appropriate to do so. Before we begin, we'd like to submit the following poll, and if you give that your kind attention, I'm sure the company would be most grateful. And I'll now like to hand over to Annemiek den Otter. Good afternoon.
Hi, good afternoon, everyone, and thank you, Mark, for your introduction. I've been asked to have this follow-up presentation, so our IR and Mats has given a presentation before about the introduction of RENEWI, what it is, what we do. So on a high level, we are a 1.8 billion waste recycling company, predominantly in Benelux and the Netherlands. Given you've had an introduction, we will now hop on to the last figures, the annual results, and the presentation and the details we presented during our annual results. Again, any Q&A can be submitted, and I'm more than happy to answer. So I will try and take 20-25 minutes to run you through the annual result deck, and then happy to answer any questions you may have. Of course, here's the disclaimer. I will not read that out to you, even though that may be disappointing. And we will be starting on how we progressed on our strategic priorities. During Capital Markets Day in October last year, we have presented to our shareholders and to the investment community that we are having three priorities. First of all is optimizing our portfolio. The second one is building a strong platform for growth. And the third is to capitalize on the sector growth. So when we look at optimizing our portfolio, historically, RENEWI has had a number of companies that have been very promising and very well performing, but also another number of businesses that have been distracting. The two, I think we've had a few. So we had Coolrec and Malta being quite difficult a couple of years ago, whereas we have now, with new management and a number of reasonably limited investment, we've been able to turn them around to now sit well above the 10% EBIT margin. The other two are Minerals and Water, and also the UK business. So Minerals and Water, I'll come back to that in a bit more detail in a second. But there we have been working over the last couple of years to make sure that we return that to its original profitability. And as the numbers, as you are probably already seen, we've made very good progress in the last year. And then there is the exit of the UK, which is really a game changer for our company, to now have been able to find a buyer for our UK business. And also we'll get into a bit more detail. But in general, we've seen that the more troublesome businesses have been either turned around or are well on its way, or they have been divested, which means we have a much cleaner profile. And we can also focus on the core of our business, growing it, improving it, and making sure that this becomes a strong platform for growth, which is our second priority. So our first one is to get to high single-digit margins. So during FY22 and 23, there we have seen that we have been pretty close to high single-digit, but that was mainly because of high recycled prices. What we've now said is we will assume historic average recycled prices, but we should be able to get to high single-digit margin simply by executing on our strategic agenda, making sure our company becomes more efficient and at a lower cost base and growing at the same time. Free cash flow has been a very high priority on my list as a CFO since I started 2 years ago. And then also the return on capital employed, where we are both looking on the capital that is used in the company, but also, of course, the improved margins will help there to get to the targets that we've set. So we've set clear targets. I'll come back to that in a second. Capital allocation policy has also been sharpened towards both shareholder returns, but also to make sure that we are putting the right capital to where it yields the most. And also we are resuming a progressive dividend, which we have also announced that we will restart paying dividends as of this year. And then last but not least, it's important to first improve margins and to get the base of our company right. But we should also be able to make sure that we are able to capitalize on the momentum that we see in the sector. So the organic growth, we have set over 5% per year, which given we are largely driven by, on the one hand, inflation, but also on the which is passed through in our contracts on our inbound revenue customers. But we should also be able to pick up some additional market share because of our unique propositions that are becoming more and more relevant in an ESG-driven world. And also we are expanding capacity. We have already done a number of significant investments over the last 2 to 3 years, and this should also help drive growth and also add to our margins. So this should lead to roughly 2.5 billion of revenue. And once we have really optimized the portfolio, ensure that we do get to these high single-digit margins and to do free cash flow, then we should also be able to add some to play a role in the consolidation that we do see in the sector. So a quick word on the exit of UK Municipal. As I said, this really simplifies our portfolio. It's boosting our margins, our EBIT margin by 50 basis points because we take 0 EBIT revenue, and the revenue was around 180 million for the UK. The UK on average took up 15 to 20 million of free cash flow per year. So that means that cash outflow will be gone. It is significantly de-risking the group's balance sheet, and also it's prioritizing our management time and our resources towards things that bring us much better returns. So we've sold our business to Biffa. So we've signed end of May, and we're working throughout the closing in the next couple of weeks to get that done before the end of the year. We have to put in a capitalization for this because they are deeply loss-making contracts, and we have funded this from existing, or we will fund this from existing debt facilities and expect to complete, as I just said, before the end of 2024. And of course, we're trying to complete sooner rather than later. Then minerals and water. And what you see here is the step up that we have made. So in 2018, there was an EBIT of around 24 million. And then we discovered we had to turn this business around to from producing terminally clean soil to really produce a number of products that could be sold into a wider market, such as the concrete and the cement industry. So over the last couple of years, we've been working on it. And finally, last year, what you see here is a step up from the 0.5 million of EBIT to the 9.6. And that is a result of on the one hand, the turnaround and the work that we've been doing to make building products, and also improved quality, which means we can get better pricing, not just at the intake, but also at the offtake of minerals and water. So we improved the quality. We also reduced the inventory that we had to deal with, and our EBIT increased with more than 8 million in the second half. So are we out of the woods yet? Well, there's still some work to be done. So we have not sold all our legacy inventory yet. And also we need to make sure that we maintain and stabilize the run rate that we have achieved. And also we need to work on consistency and further increase the on-spec production of filler and sand. and make sure that we consistently perform. But so far, we are very pleased with the results that we've seen come through during the last 3 quarters of FY24, and also the consistency thereof. Another thing that is important in realizing our strategy is the way we've been organized. So we were organized with 4 different divisions. And what we're now doing is, in order to really drive efficiency, but also to make sure that we really use our scale also for growth, also for simple things like customer references. How are we approaching the larger customers? We have decided that our business needs to be reorganized and streamlined. So commercial waste used to be Commercial Waste Belgium and the Netherlands. We have now combined that into one, and also made sure that we can focus now on inbound sales, on logistics, on processing, and on outbound sales. Whereas before, this was all organized, more or less per site. But in order to really utilize our scale, both for logistics and processing, etc., and to move up, it's important to also make sure that we get better and better, more and more efficient in terms of logistics and also our processing sites. And specialities there, of course, municipal will be divested and completed later this year. And that means that we have put together Coolrec, Malta, Minerals and Water, as they are very highly focused on processing monostreams, and they have a very distinct customer base, which is one of the reasons why we are keeping them apart. And the other thing we are doing is we were a bit of a halfway house in terms of our functions, both finance and HR, for example. And there we have decided to centralize, also to make sure that we will drive further efficiency. So when we look at FY24, we were in line with the latest market expectations. So our revenue came in at 1.9 billion and an EBIT 107, and we had 70 million of adjusted free cash flow. So that is before growth, capex, and of course there was no dividend yet. It's a stronger second half compared to the first half, which was mainly driven by the recovery of Minerals and Water. But also in the last quarter, some benefits of the Simplify program that we introduced. Then the high inflation was more or less offset by price increases, plus some cost savings initiatives. Recycled prices were rebased to historic averages, so the big peak that we saw during and just after COVID has settled to much less volatile, but at a lower level. But it has remained stable since. And then also we saw the market weakness, particularly in commercial and construction and demolition, which caused us to lose some of our volumes. So we'll target some segments to repair that. And finally, we also made sure that we accelerated our plans to reduce our SG&A cost with the Simplify program, where we took out 160 FTEs, resulting in a cost saving of 15 million. A couple of million were in FY24 in the last quarter, but roughly 10 million will be helping the results of the current year. So this is income statement. Again, this is already restated for the UK. So the UK has already been taken out, as these are now classified as assets held for sale by the time we presented our annual accounts. So there you see basically the input revenue and a growth of around 4%, which is basically the net result of a price increase of above 8%. But on the other hand, lower volumes, which results in a net change of a growth of 4%. But the output revenue has clearly been impacted by the rebased recycled prices. Then our EBIT has also been impacted by both the recycled prices, but also the volumes. And then also our net interest, given we have a slightly higher leverage and also a higher debt base as a result of the acquisition that we did at the end of FY23, increased our net interest, resulting in an underlying profit before tax of 68 million. So just to give you an idea of how the EBIT went from FY23 to FY24, and there's also, of course, a small EBIT contribution that came from the UK. But here you see our price increase was really significant at 106. So we've pushed through roughly 8% price increase, but the cost increase given wage inflation, etc., but also higher diesel prices, higher energy prices, etc., were more than what we were able to offset by the pricing. So we did instead also some additional cost savings to make sure that at least we were able to protect our margins from inflation. Whereas in any normal year where you have a bit more moderate inflation levels, there we would generally pick up a few basis points extra EBIT. Whereas here we had to work quite hard to make sure that we actually didn't deteriorate margins because of inflation. Then recycled prices, of course, they came down, which had a significant impact. And then the volumes was another larger mover, where the construction and demolition market in the Netherlands particularly did not help us. So that's roughly gets us to the 106 or 107 million of EBIT, and then a very small plus in the UK means that we came in at 105.5 from continued operation. Cash flow was better than expected, and also I think the most important thing here to note is we are expecting for the year to come that the COVID tax, so in the green block you see that we've always or historically been hurt by what I call legacy cash outflow. That is, we haven't paid any of we've deferred taxes under the COVID relief schemes, roughly 60 million, 60. We've now paid down 50, so we only have 10 million to go for this year. So that will already be a good step. There's still also some offtake of ATM soil to go. And then, of course, the UK municipal contracts will disappear. So that will already be a significant, say, 35 to 40 million of help in the cash flow going forward, because this has historically been a big issue and big reason why our EBITDA and our EBIT did not translate into decent cash generation. So this is a major step. Also, we are working on our working capital, where there is still efficiencies to be had, and also replacement capex. As we become a more efficient company, the reason it's much lower than last year is because we sold. As part of our consolidation plan in Amsterdam, we sold a major site. So this is the net figure of that. But we're also looking at how can we become, well, maybe not asset light, but at least asset lighter, and be more efficient with our sites, our trucks, our fleet, and our containers. So all in all, that's been leading to a free cash flow before investments in growth and before acquisitions, and of course there was no dividend yet in FY24 of just under 21 million, and given that situation, we have announced we will start paying a dividend as of this year, which will be introduced and proposed in the AGM later this week. So just a quick word on the UK Muni divestment. This is really a big step in the history of Renewi. If you look at the owner's contract provision, sort of on the top right hand side, there you see that actually over the last couple of years there were many step ups in the provisions. There were write-offs, etc., amounting to almost 250 million last year. And also at the same time, there was also the cash outflow amounted to almost 120 million. Whereas what you'd normally see if you have cash outflows, you basically means you are repaying a debt. Whereas here, the provision or the debt-like item only got worse. So for us, this was an important reason why we wanted to de-risk the balance sheet, because every time there was a new surprise, and the contracts were very difficult or actually impossible to renegotiate for us. So that's why we said we wanted to. We found it important to get rid of these contracts, so we can also get rid of this drag on our cash. So this has an immediate cash flow improvement or an EBIT margin improvement. So if we were excluding the UK for FY24, we would move up from 5.7 to 6.2. And also theoretically, then the free cash flow would have improved from 20.9 to 36.7. Of course, in the beginning, given we are funding this from debt, we will have more predictable debt compared to the OCPs and the write-offs. But of course, there will be also a temporarily increase in our leverage, but also in our interest bill. So net for the first year, we are expecting an additional interest bill, additional of say 7 to 8 million. But as we are really laser focused on bringing that leverage back down, also the interest bill that is associated with this will come down quite quickly, and then we will have the full benefit of no longer having the cash drain, but also the overhang on our share price of an uncertain business. So in terms of the liabilities that were on our balance sheet, here you see that we had roughly 200 million of assets. We roughly had a bit less than 300 million of liabilities, which means that our net liability was 89 million. And we agreed with BIFA we would capitalize the business with 146 million or 125 million pounds. And this results in a net loss on sale of 57 million. So the way that I tend to look at this 57 million loss is basically the risk premium that we've paid in order to get rid of this major uncertainty on our balance sheet. So we are funding it from our balance sheet. So end of the year, we had 300 million of liquidity headroom. We have a strong balance sheet, but yes, it will increase during the year when we are funding the divestment, but also we have some additional. There's also a bond expiring end of June this year, so we decided that combined with the UK Muni divestment, we wanted to take some additional liquidity on, which is 120 million bridge facility, which is actually on just as competitive terms as our revolving credit facility. So we were quite pleased with the three Dutch banks supporting us and also supporting us very quickly to get this done. So our leverage will be temporarily elevated to around 2.9. But we are confident we can deleverage quite quickly with roughly half a turn per year because our margins are improving, our cash profile is improving, and we are growing our business. And then we should be able to return to a leverage of the 2 times we've committed to pretty shortly. So given I'm already taking a bit more time than I had expected, so I will very quickly go over commercial and over the divisions. But here you see the result of mainly output revenue for recycled prices, but also the volumes that have dropped, which means only the input revenue only grew with 3%, whereas we had quite significant price increases, resulting in a minus 2% and also impacting our underlying EBIT. We took cost actions, which will underpin the margins going forward. In Belgium, we also saw back to volume growth during the second half. Also here, significant impact from the recycled prices, but there this was a bit more offset by cost control, which means that the underlying EBIT margins stayed closer to 10%. Minerals and water I already touched upon. There we've seen a really good and strong performance increase after a bit of a slow first quarter. But here we see the almost 10 million or 5.3% EBIT margin as a result of the improvements we pushed through. And then specialities, there we've seen that both Coolrec and Malta have done well. Coolrec has suffered a little bit under the plastics prices, which are now stabilized or slightly above last year. But Malta have had another phenomenal year with even though the volumes were not that fantastic, but they made a lot of investments in the quality of the glass cullet of the product that they produce, which underpinned the price improvements and the price increases for the offtake side. So all in all, what are our targets? We are reiterating, we've set 8 to 10% EBIT margin in the next 3 to 5 years, a free cash flow conversion of 40%. So this year we had 9. So there's still on the back of the legacy cash out that is drying up and some efficiency, we should be able to get there. ROCE, on the one hand, a more efficient use of our capital and also improved margin should get us to over 15%. And also the growth, we are quite confident we can get there, given we have, on the one hand, a good commercial plan in place. We've made some investments that still have to come through in terms of growth, but also the pricing power that we have. So margin expansion, just a quick word on that. How are we going to do that? Move from the 6 to the 8 to 10%. So first of all, 2 things have already been executed. One of them is the SG&A cost reduction program of 15 million. And the other one is the divestment of the UK. So these were already 2 tough nuts we had to crack, and we delivered them on time and on budget. Then what we are focused on now is to make sure that we are capturing and recapturing market share through commercial excellence, having the right propositions and making sure that we really capture additional market share, because a lot of the larger customers and the larger parties in both the Netherlands and Belgium are looking for a partner that can help them get to zero waste and to reduce their residual waste. And we are one of the very few who can properly do that and also can show them the data behind it in terms of recycling rate and what is happening with their waste streams. So that is a very, very strong, unique selling point that we have and that we are yet to embark on to properly make sure we use that in a commercial sense. Then further SG&A reduction. We did a good step last year, but there is more to come because our company is under-digitized and has a lot of opportunities to become more efficient and to use digital tools to really improve our SG&A and particularly our admin cost. And then finally, growth. This is also the returns from the projects that we've invested in. So I think a couple of years ago, we announced we were going to invest 80 to 100 million in growth projects. We have invested now around 60 million. And the 3 larger ones in that 60 million are the bio-LNG factory that we have in Amsterdam. It is the plastics hall we commissioned a couple of months ago. And it's the Ghent advanced sorting line that we commissioned last year in Belgium. And these 3 projects should also be able to, together with some other ones, should be able to drive part of that margin expansion, because so far, because these projects have just been in commissioning and the contribution has been relatively limited as per the plan, but this should also come through in the next couple of years. So for us, important, boosting shareholder returns. That's why it was extremely important to clean up the profile, but also clean up the balance sheet, get rid of legacy cash outflows so we can show a much clearer path to shareholder returns. Dividend payments will be resumed and we will focus on driving shareholder value. So we've set a dividend of 5 pence per share. It's not a lot for this year, but given we also had to fund the divestment a business. We thought that this would at least show our commitment to our shareholder and then to our shareholders, and also then we will commit to a progressive dividend, which means it will become progressively more, ultimately targeting an underlying earnings cover of 3 to 4 times. And then we will invest 30% of free cash flow in innovations and growth capex. And also we will focus on deleveraging in the next 12 to 18 months, both through margin improvement and EBIT improvement, but also by paying down part of the debt. And then finally, of course, when there is excess capital, once we have done all these things, we will either do consider things like share buybacks or think about additional dividends. So in summary, our focus for the coming year and also the years thereafter is our revenue growth. Make sure that we are taking our share in the markets, that we are growing, and we have already executed our pricing program for 24. And we are also expecting, on the back of commercial efforts, to see some modest volume growth. Our cost is an important topic. So the SG&A cost reduction is coming through, but also the organizational restructuring is providing further scope for efficiency, as is our digital agenda. And then finally, excluding the UK divestment, we will have a free cash flow of around 50 million, benefiting from the UK exit, and also have a positive total cash flow after dividends and growth capex, which is an important step in getting a very healthy company. These are the 5 sectors that we have highlighted during Capital Markets Day: construction, demolition, glass, organics, plastics, and zero waste solutions. We have a number of programs underpinning these, where we are looking at projects, and they will be included in the program of the next 3 to 5 years. But again, I think it's important to stress that we can also achieve a significant part of our growth without the capex, and this will really help us to make a further winning proposition within those chosen areas. So with that being said, and me being 10 minutes longer than I had said originally, I'm more than happy to take any questions.
That's great, Annemiek. Thank you very much indeed. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. So Annemiek takes a couple of moments to review your questions submitted already. I'd just like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your Investor Meet Company platform. Annemiek, as you can see, you've had a number of questions from investors. So firstly, thank you to everybody for your engagement this afternoon. If I may just hand back to you to read out those questions, and then I'll pick up from you at the end.
Yeah, sure. How should we think about a normalized growth rate for your business, in line with GDP or ahead of GDP? I think what we've said is we should on average be able to achieve around 5%, which is slightly ahead of, because we tend to think and link it with inflation, because we can push through inflation in our pricing. So if volumes stay stable, then you could assume our top line to grow with that number. But also we are expecting to be able to get some more market share, and also GDP growth, of course, is helpful. We were hurt a little bit by the construction and demolition sector, in particularly in the Netherlands. But there also we see some stabilization, which will be helpful. But in general, we should be able to achieve on average 5%. Then a huge number of facilities or sites. Is this footprint necessary to stay close to the customer and or due to the economics of collection? Or is there scope to rationalize the premises? It's a very good question. It's one of those things that is linking into what I call not asset light, but asset lighter. So I think there is scope to do some rationalization. The reason that we have this footprint is also that the company has grown because of acquisitions. And then it has been a while since the footprint has been seriously reevaluated. So we've just kept on adding. I think after the acquisition in Amsterdam of Westport in 2023, there we have actually sold one of the major sites there as part of rationalization. But I think there is more that we can do, and we are looking into that as well, because it's actually also helping with maintenance capex, but also operational efficiency, etc. So there is scope, but I haven't put a number to it yet. It's we're still in the middle of doing that work. But also one of the important things to realize with our sites is that our business is very much linked with permits. So when we sell a site, etc., we also have to be very mindful of the permits associated with that. So it's not so much a matter of when you're pure logistics or you do say pure DHL, FedEx type stuff, but we're also bound to certain areas where there are permits involved. But yes, we do think that we can be a bit lighter on footprint. Then, are there plans to expand Renewi's operations beyond Europe? And if so, what regions are being considered? No, we're not. Not at this stage. We are at this moment a Benelux company, and we have some operations in France and in Portugal. And I think our first priority is to make sure that the core of our business is performing well and generates the cash and the margins that we've committed to. But then there could be a good moment, especially for our specialized businesses like Coolrec and Malta, that we are expanding within Europe, because for us it's quite important to really understand the regulations and be close to our operations. So beyond Europe is that would be very far away. But within Europe, once we have our house fully in order, then that would definitely be something we could consider. Then how are we positioning it to take advantage of regulatory trends and the increasing demand for recycling and waste to product solutions? Yeah, I think this is linking right to what I tried to explain on our commercial propositions. It's very important to realize that we have a great proposition in hand, and we see a lot of customers are responding very well to it. So, for example, we have great customers like Nike, like Dove, and like many of those other blue chip companies, Schiphol, who have committed to getting to zero waste or zero residual waste, and they're looking for partners, and all these large companies are looking for partners who actually know what they're doing and that can also help them with reporting showing that their carbon footprint, because of a better waste management strategy, is really reducing. So I've been a CFO only for 2 years at Renewi, and when I started, my conclusion was, even though commerce is not always the top of the priority for a CFO, but I do like to understand that, because in the end, everything begins and ends with our customers. But there, my conclusion is that we are not really where we need to be yet and where we can be. So this is still an opportunity, and it is something that is now being picked up by our commercial leaders. And also one of the things that we've done in the last 6 to 12 months is replace our commercial leadership in Commercial Waste Netherlands, in Commercial Waste Belgium, and in Minerals and Water, because we wanted to have some fresh pair of eyes and also different leadership who are also understanding this opportunity and making sure that we move our sales forces from just selling containers to actually becoming a partner to these larger companies, because there's definitely an opportunity. And in addition to that, what we also see is for the larger tenders, more and more points are being awarded by being ESG proof, by having good reporting on what actually happens, by circularity, etc., and less on price. So also the last tender that we won for Schiphol, which was really a major win for us, is that we really won on quality and not on price, which is a good thing. So what factors influence the decision to reinstate a dividend, and how sustainable is the dividend payout in the long term? I think the key one is commitment to our investors. We said we would restart paying a dividend, so we did. But because the significant amount we need to pay to divest our UK business, we've said let's do it, but let's make it a modest amount that we can swallow at this moment. So that was the main two reasons. We promised it, so we want to do it. And the second one is let's be careful, given our leverage will be moving up to 2.9. What I just said about our cash flow, because we fixed if we divested the UK, minerals and water is already a lot better, and also our deferred COVID taxes are almost repaid. That actually means that our only by these legacy items alone, our cash is already improving with 40 million a year, and we will be doing more also on efficiency, as I referred to earlier. So that also means we will have more room for dividends going forward, so we can also live up to our promise of paying a progressive dividend. So cash flow was 8.8 million lower, excluding UK. How does this tally with the 15-12 provision for the UK? I'm not sure I follow that, because excluding the UK, the cash flow would have been better, and the provisions were roughly 150. So I'm not sure I fully understand the question. So if you don't mind, I'll skip it, or if you could rephrase, then I'll try and answer it. Then would you consider capital light expansion into European markets where you contribute your technology and know-how and local partners put up the capital? Yes, that is definitely one of the paths that we would be considering. So we are looking at ways like that for example, for Malta and for Coolrec, because these mainly involve factories, whereas our commercial waste business also involves a whole fleet and collection business, and that always makes it a lot more capital intensive than our businesses in Malta and Coolrec. So that is definitely one of the ways to go once we get there.
Annemiek, that's very kind of you. You have taken all the questions. Obviously, if Neil does resubmit that question, we can make that available to you post today, and we can publish a response if that's appropriate to do so. Well, thank you very much to everybody for your engagement. Annemiek, I know investor feedback will be particularly important to you, and I will redirect those on the call to give you their thoughts and expectations. But before doing so, if I may just ask you for a couple of closing comments, and then I'll send investors to give you their feedback.
Yes, absolutely. Well, thank you again for joining, and for your interest and for your questions. So indeed, I will try and answer if anything else pops up later on. That's no problem at all. Again, I mean, I would like to reiterate, we think that the company is very well positioned for growth, given where we are in our proposition of being a pure play recycling company in a European market where all regulations are helping us in the near and particularly the medium term. But at the same time, we are also executing on margin expansion and the self-help program. So for our for getting to the 8 to 10%, we can also achieve that without the law and regulation help, without the help from Recycled. So we can do that by ourselves. So we think this is very well achievable, and we are also very excited to do this and to make sure that we make a great company and also leading to great returns for our shareholders.
That's great, Annemiek. Thank you once again. Can I please ask investors not to close this session, as we'll now automatically redirect you for the opportunity to provide your feedback in order that the company can better understand your views and expectations. This will only take a couple of moments to complete, but I'm sure it'll be greatly valued by the company. On behalf of the management team of RENEWI PLC, I'd like to thank you for attending today's presentation and wish you all a very good afternoon.